Hello everyone, welcome back to our managerial accounting class. Hope all of you are doing great. This week we will learn a new topic. We will learn about budgeting. I hope all of you have heard the term budget. Right? It's not only for the business students or for an accounting major, even for our personal life, we need to think of this concept which is budgeting. For example, if you plan for a vacation, you need to prepare your budget, how much money you can spend on your plane fare, what type of hotel you want to live in, how much money you're gonna spend for your meals, what type of entertainment you really want to enjoy, and you need to plan everything ahead. That means you need to make your budget. So we actually do this budgeting in our day-to-day life. So in this chapter, which is chapter 9, we're gonna learn about different types of budget, and those budgets are from a manufacturing company's perspective. So we basically will focus on sales budget, production budget, direct materials budget, cash receipt, and cash payment budget. So what is budgeting? Budgeting is just a plan. Okay, so when you are expressing your plan in terms of monetary unit, it's budgeting. Right. I just mentioned about your vacation plan. If you have a vacation plan, of course you gonna check each and every item's costs, right? Your plane fare, your hotel fare, your meal cost. That means you have something in your mind. That means whatever you have as your plan, you need to express it in terms of dollar value. And when you are expressing your plan in terms of dollar value, it's your budgeting. So budgeting usually is for a specific time period, and it could be for 1 year's budget, it could be for a quarter budget or weekly budget, or for a specific project or product related budget. So budgeting is really helpful for the managers because it helps them to determine that what amount of resources they need to spend on to produce certain amount of products, and it also helps them to forecast their future costs and future revenues. Here in this slide, I actually posted a link, so I'd request you that you will watch the video and you will get a little idea from a real world perspectives what is budgeting and why it is important from managerial decision perspectives. So again, budgeting is nothing, just a plan, and plan when it is expressed in terms of dollar value, and of course it is for a specific time period. So once you do the budgeting, you need to communicate it. You need to convey the budget message to your subordinate or to the other parties that are related to your operation. Right, so budgeting is, in one sense, is the benchmark, or it's the plan that what you want to do. And then when you will operationalize or you will implement all of your plan, then you will see the actual amounts, and then you gonna compare your all actual cost with your budgeted cost. So here budgeting will be helpful to use as a benchmark of your costs. So how could you do the budget? So you could do the budgeting into two ways. For example, you could use your prior year's budgeted figure or your prior year's actual figures as a base number, and based on that you could prepare your next year's or next period's budget. Or you could do a zero-based budgeting. That means start from the scratch. So usually a manufacturing company will do different type of budget. So if you see this diagram, of course they need to prepare the sales budget where they will forecast how many units they need to sell. Based on their sales target, they will determine or they will identify how many units they need to produce, which we call the production budget. And if you remember the three types of costs, or manufacturing costs that we are learning from the beginning of this semester are the direct material cost, direct labor cost, and manufacturing overhead cost. So the managers will prepare separate budget for all these three specific costs. So basically production budget includes these three types of costs. So first you're gonna do your production budget, which is basically in terms of number of units. That means how many units you want to produce. Then you need to focus on these three specific costs, and you need to prepare three different budgets in terms of the dollar value based on your production budget. So once you will have these three specific cost related budget, then you also need to do your operating budget. And now based on all these budgeted items, you can also plan, or you can also forecast what will be your income statement or operating income. There are several other types of budgets. Now we will learn some financial budgets. So these financial budgets are of course based on your income statements. By taking all your income statement data, you can prepare this type of budget. One is your capital expenditure budget, another is your cash budget, and another is your forecasted or budgeted balance sheet. So we basically will focus on your cash budget, and cash budget is basically two types. One is cash payment budget, another is cash receipt budget. So let's see one example of sales budget. So in sales budget, you will figure out how many units you want to sell, what will be your sales price per unit, and of course based on that you will also forecast, or you will also budget your total sales revenues. Right, so in this example you will see that we are doing budget for the first quarter. So first quarter means the first 3 months of the year. So we are forecasting for our first quarter. That means it includes the month of January, February, and March. So in your sales budget, you're going to forecast how many units you want to sell. So this company, Tucson Tortilla, they want to sell 30,000 cases in January, 20,000 in February, and 25,000 in March. So they will prepare this month specific budget. You also need to do that when you're gonna do your practice problems. So you need to do these separate columns for every month, and then you will do a total column. So you see here the last column is basically the total first quarter budget, which is nothing, just the addition across the column. Then you need to multiply what will be the sales price per unit, or here in this case, in this example, per case. And their sales price is $20. That means these are their number of units that they want to sell, and this is the sales price per unit. So if you multiply this, you will figure it out what should be the total sales revenue. So these are their budgeted sales revenue for the first 3 months, and if you add all this, you will get their total first quarter's budgeted sales revenue. Now you will see a couple more columns below this sales budget. Here we are actually splitting our sales revenues into two parts. One is your cash sales, another is your credit sales. So you know, when companies do the business, they need to offer credit sales. That means they are making sales on credits where customers are not paying cash right away. Of course, you need to do that to base your customer base, or to maintain your customer base. If you don't do that and your competitors offer credit sales, then there is the chance that your customer could switch to the other competitors. So now what we're gonna do, this is, you see in this row, what I'm showing you, this is your total sales, and then you splitted it up, probably based on your prior experience, that 20% of your total sales will be the cash sales and the 80% will be the credit sales. So once you splitted it up, so we need to take 20% when you're gonna show the cash sales numbers For example, for the month of January, if you take 20% of 600,000, that will be your cash sales. Again, if you take 80% of 600,000, that means the rest, that will be your credit sales for the month of January. This is how you're gonna split it up, your total sales revenue, into two parts, cash sales and credit sales, based on this 20-80 ratio. And you will see the total sales revenue will be the same like this total sales revenue. And of course you will also check the grand total. So whenever you will do any budget, I suggest you, when you need to figure out the grand total number, add it vertically and also add it horizontally, just to double check that your grand total is right. For example, this is our first quarter of the total amount. So if you multiply this 75 times 20, you should get this 1,500,000. This is one way to find out your total. Another way is to add all these January, February and March total sales revenue, which are 600,000, 400,000 and 500,000. If you add these three, you will also get 1,500,000. So the best way is to do the both. Check it vertically, also check it horizontally. The same thing here. Here we just split it up into two parts, cash and credit sales. So you could add these two, you will get the same number, 1.5 million. This is our vertical addition. We will also do the horizontal addition, and just to double check that your grand total is correct. Now let's see the production budget. Okay, so production budget is basically based on your sales budget. Remember, this production budget is always in units, and this budget tells you how many units you want to produce. Right, so based on your sales budget, let's go back to our previous slides. This is the sales budget in units, right? The first line tells you how many units you want to sell. 30,000 units, 20,000 units and 25,000 units. So you will start your production budget using these sales units, right? So these are our sales units. All these are unit. I'm repeating, production budget is always in units. No dollar values here. Now, when you're gonna do the production budget, you need to remember two important things. One is your desired ending inventory, another is your beginning inventory. So when we are doing production budget, we are basically thinking how much inventory we actually need to sell our targeted units. That means how many units we need to produce. Right, so these are the sales, forecasted or budgeted sales. So to reach out all these sales number, how many units you need to produce? You will see that in real world, business always have some unsold or leftover units. Right, that means when you start a fresh new year, you may have your previous year's unsold or leftover units. Right, that means the units you actually produced last year but you couldn't sell. So last year those unsold or leftover units were your ending inventory, and then when you start the new year, those will be your beginning inventory. Right, so beginning inventory means the inventory which is already, those are already in your warehouse. Right, so you actually don't need to produce these units. These are already here from your prior year's production. Now you have these targeted sales. Now managers will always try to keep a bulk of inventory as their desired ending inventory. This is just the safety cushion, right? Because if they run out any inventory or any amount of units, they will be in a trouble. For example, they don't have any desired ending inventory, they don't have any cushion or safety inventory. if any customer wants to buy this and they are not able to produce those, they will be in trouble. So that's why managers usually try to save a portion of their inventory as a ending inventory. That means they always want to keep some units as a safety cushion. This is called desired ending inventories. Now let's start from the beginning. Let's take the example of January. Their unit sales is 30,000. That means this is the 30,000 cases they want to sell. Plus, the condition is that managers always want to maintain an ending inventory which is 10% of the next month's projected sales. So whatever is the next month's projected sales, they're gonna always keep 10% as a safety cushion, as an ending inventory. So that means in February they want to sell 20,000 units. So if you take 10% of it, that is 2,000 units, that's the manager always want to save it or just keep it as their desired ending inventory at the end of this month, January. That means if you add these two, that's their targeted sales plus their desired inventory. That means these two together, which is $32,000, is their total need. Now remember, they may have some beginning inventory from their prior months or prior years. That means they already have some inventory in their warehouse that they don't need to produce. Right, so their total need based on their target sales and desired inventory for the month of January is 32,000. Then they already have some beginning inventory, so that means they don't need to produce it. So they will subtract this beginning inventory, right? And this is how they will actually figure it out how many units they really need to produce. So that means if you subtract this 3,000 units from 32,000 units, you will get that the total number of units they need to produce is 29,000 cases, right? That's the month of January. Now we're gonna do the same thing for February. Again, February's targeted sales is 20,000 units. They have the desired ending inventory, which is 10% of next month's targeted sales. They already have some beginning inventory. Remember, whatever was January's ending inventory will be the beginning inventory for February. Right, so last month's ending inventory will be this current month's beginning inventory. So in January their ending inventory is 2,000 units. So for the month of February, this 2,000 will be their beginning inventory. Right, and this is how you will figure it out how many units they need to produce. So we're gonna do the same thing for March. But for March, you also need to figure out what should be the ending inventory, but you really don't know what is the targeted sale for April, right? Because we are just showing in this table only for the first quarter. But for every problem, it will be given to you. So this problem also tells that their projected April sales are 32,000 units. So this is their April's targeted sales, so they will always keep 10% of it as their desired ending inventory. And this is how you got that for the month of March, their desired ending inventory is 3,200. So if you add these two, their target sales and their safety cushion or desired inventory, then you will figure out they actually need 28,200 cases, but they already have 2,500 cases. Those are their beginning inventory. That means these were their last month, which is February's ending inventory. So they don't need to produce these 2,500 units. So you're going to subtract it, and this is how you will figure it out how many units they need to produce in March. Right, so this is how you're going to do every month or every period's production budget. Then you need to do the total column. So for the total column, of course we usually add across the columns, but there is one tricky thing for the desired ending and beginning inventory. So for the ending inventory, you cannot add all 3 months ending inventory, right? Because ending inventory means whatever you have at the end of the quarter. So at the end of the quarter means end of the month March, right? So whatever is your March ending inventory will be the whole quarter's ending inventory. Right, that's why you cannot add all these three things. Just take March's ending inventory for the whole quarter's ending inventory. I'm repeating, for ending and beginning inventory, you should not add across column. So ending inventory for the quarter means that the ending inventory for March, right? So March 31st is the last day of the quarter, so whatever is the ending inventory for that month or for that day will be the entire quarter's ending inventory. So for the ending inventory for the whole quarter, we will take March or the last month's ending inventory. Similarly, for the beginning inventory, don't add across the columns. Take whatever was the beginning inventory for the very beginning. So the beginning inventory for the month of January was 3,000. So these 3,000 units will be the entire quarter's beginning inventory. That means the quarter's beginning inventory means whatever they had at the beginning of the quarter, right? So beginning of the quarter means January, so whatever they have at the beginning of the quarter will be their quarter's beginning inventory, right? And now this is how you will find what will be the total number of units to produce. So again, we will check it vertically, and we will also add this to check it horizontally, right? And for the month of January, this beginning inventory, either it will be given or you will have some information for the past year's December, and based on that you can figure out this beginning inventory. We will see several examples. Now we're going to do the direct material budget. So direct material budget means that what amount of direct material you need to buy and what's the cost. Remember, direct material budget is based on your production budget. So the production budget is telling you these are the units you need to produce, and based on that we'll figure it out how much direct material you need, and then we'll check what's the cost of your direct material, and then we'll figure out what's the total cost of direct material there that you need to purchase for this specific month and for the entire quarter. So let's see the direct material budget. So again, we'll have separate columns for each month and the total column, and this first line, which is units to be produced, we are taking it from our production budget. So this is the production budget. So if you take this, you will get your total units to be produced. Then you're gonna multiply that how much direct material they actually need. Remember, the production budget is telling you the number of units that you want to produce, and the direct material budget is telling you how much raw material or direct material you need to buy, right? So here in this example, for example, the month of January, they want to produce 29,000 cases of tortilla, and for each unit they probably need flour. Flour is their direct material, and which is in pound, they need 5 pounds of flour. So you will multiply these two to get what amount of total direct material they need, right? So you have your targeted production numbers, and then you multiply how much raw material or direct material, in this case tortilla, so the raw material is the flour, they need 5 pound of flour or raw material for each case. So if you multiply these two, you will figure it out what will be the need of their total raw materials or direct materials. Now again, for direct material, they may have some plan to keep some safety cushion, right? That means they really want to keep something as their ending inventory. So this is their production need, right? This is their production need. Now you have to add that safety cushion, or that is desired ending inventory, and their condition is that they always want to keep like 10% of next month's production need, as their desired ending inventory. So you will check what's the next month's production need, then take 10%, and you're gonna keep those as their desired ending inventory. Again, for the last month, which is March, in this problem it is given that what will be their April's production needs. So for every problem you will know what will be their next month's or the prior months for prior month's production needs, so that you can calculate their ending and beginning inventory. So now if you add these two, you will find what's the total amount they need, and then they need to subtract their beginning inventory. So for the first month you will have enough information to calculate it, and for the subsequent months, remember whatever was the last month's ending inventory will be this month's beginning inventory. For example, February's ending inventory was 12,850. That will be March's beginning inventory. So now what we're gonna do, we will subtract our beginning inventory, because these are the amount we already have, so we don't need to buy those. And once you subtract these from your total need, you will figure it out how much raw material they actually need to purchase. And this is how they did this column, quantity or total amount of total how many pounds of flour they need to purchase. And it is also mentioned that the cost per unit is $1.50. So you're gonna multiply this, and then finally you will get what's the total cost of their all of those direct material that they need to purchase. Remember, up to this, all these are in units. Then in the last column, last row, you are multiplying it by the cost per unit, and then finally you get the dollar value. So just the last line is the dollar value, because you are multiplying it by the cost per unit, but all previous information here are units, right? Again, we need to do the total column, and the idea is that for the entire quarter's ending inventory will be the last month's ending inventory, and the beginning inventory for the whole quarter will be the first month's beginning inventory. So this is the thing you have to remember. The rest is as usual. We will add our production need, then we're gonna add our we will multiply this number of product units we want to produce, how much we need for each unit. If you multiply, it will give you the production need. Then you have to add your desired ending inventory, then you need to subtract your beginning inventory. This is how you will find your total amount of direct material that you need to purchase. Then you're gonna multiply with the cost. This is how you will get your total cost. So this is how we're gonna prepare the direct material.